Hi, I'm Pattu from FreeFinCal. In today's video, let's talk about how to invest without using mutual funds. If you look at mutual fund articles online from bloggers or in the media or on social media, wherever, sometimes you might get the impression that if I don't use mutual funds, I'm probably not financially literate. Or people talk about investor education and say mutual funds have got these advantages, etc., and so on. There's nothing. Investing in mutual funds is just a choice, and that has got nothing to do with financial literacy. Financial literacy is something else. It is a very clever propaganda by AMC guys, their sales guys, and so on, and irresponsible people in the media to kind of give a projection that as if unless you are investing in mutual funds or equity mutual funds or whatever debt mutual funds, you are not doing the right thing or you're losing out on something. Not really. It's just a choice. Every choice has got pros and cons. It's just a matter of understanding what those pros and cons are. Now, if you ask what exactly is financial literacy, it can be broken down into just three steps. One, we need to protect our family with at least life insurance and health insurance and have enough emergency fund until our net worth builds up. After our net worth builds up, you don't even need an emergency fund. If you are, I keep saying about talking about multi crorepati. If you are a multi crorepati, you don't a multi crorepati need not worry about 6 months expenses in a savings bank account. For them, they can just sell some shares and that's an emergency fund. So until you reach that stage, you need an emergency fund, at least until you reach that stage. Then we have to avoid unnecessary debt. Debt can really be a problem with respect to building wealth. And third, we have to recognize the importance of inflation over the long term and invest accordingly. That's all. That is this. If there is a syllabus for financial literacy, that's the syllabus. If you know that, how you choose to implement that is up to you. What you buy is up to you. I mean, it's you can't say this is the right choice, that's the right choice, and so on. We have to understand that personal finance is first personal, then only anything else. So imagine you are a financial planner and somebody comes and says, of course, when I say financial planner, I automatically mean you are a fiduciary, fee only financial planner, which means you don't get commissions, you're not selling other people's products, you don't profit off a client's net worth, a percentage of the client's net worth, and so on. So you do what's best for the client. So if a person says, I'm not going to invest in mutual funds, you give me a plan, then what are the product suggestions you would give? That's what I want to talk about in this post. And obviously there are going to be some eliminations. There are going to be pros and cons. We are going to eliminate products which have got more cons than pros. The first product to be eliminated is real estate. It is illiquid. It's not transparent. You need a loan to get it. Most people need a loan. It is very low yielding. You have got several difficulties at the time of buying, selling. It's got unknown risks which can come and bite you at any time. So real estate is gone. You don't want to buy ULIPs because ULIPs are anyway mutual funds. First of all, it's just mutual funds with the interlinked insurance where the premium is paid off in terms of mutual fund units. So that's anyway gone, and you don't want to get married to a mutual fund. And ULIP is a mutual fund where you get married to. So you don't, if you get out, you lose the insurance benefit. So it just makes no sense. Gone. NPS is a mutual fund, and NPS has got this absolutely stupid clause. The reason why I keep opposing NPS is if you retire one day before you achieve the age of 60, you have to annuitize 80% of your corpus, which is stupid. And imagine how many people in the corporate world are going to work until 60. It's just not on, and it's just crazy. Anyway, NPS is a mutual fund, so that's gone. Gold is too volatile, too unproductive an asset class, and it becomes, when the world is unhappy, the gold, it's an asset class that moves up. You don't want to be investing in that kind of an asset class. That cannot be your primary asset class. So anyway, gold ETF and gold funds are mutual funds. Sovereign gold bonds cannot be used for portfolio management because you can't sell them and buy them freely when you do portfolio management. Sovereign gold bonds are for accumulating gold for marriage and so on. That's a different thing. We don't want to do that. Let's forget about all these chit fund business, very high interest, fixed deposits, corporate deposits, the risks are unknown there. I mean, suddenly something can go wrong with the company and you lose all your money, and that kind of thing is very, very dangerous. I don't want that. So we are now going to avoid equity mutual funds also. That's gone because the client doesn't want it. We are an advisor. Please recognize, please don't say equity mutual funds has got this benefit, that benefit. If you are a distributor, please don't watch this video. Don't waste my time and yours primarily. So I am not saying mutual funds are, please don't misread this video. I am not saying mutual funds are bad. I am saying mutual funds are just a choice. They are a good choice. They have got many pros, many cons, like any other product. And if somebody doesn't want mutual funds, that doesn't mean they are financially aware or anything like that. And if you want to avoid equity funds, the choice is direct equity. You can choose direct equity. You can have a stock portfolio. Nothing, it's not impossible. If you want to invest in stocks, you have to do a lot of research. You have to do all that is bullshit. You can do very simple. Just track 30 stocks of Sensex, or at least the top 15 stocks of Sensex. You got most of the Sensex because of the market capitalization weighting. That's enough. You can do a simple tracking that way. You need discipline. Of course, for what part of investing do you not need discipline? For mutual fund investing also you need discipline, or you can choose a simple low volatility kind of stock investing. I keep talking about that. I have a video on this. It's fine. Let's avoid things like PMS and so on. That's very dangerous. It can be too much of it's too dependent on fund manager risk. So it's a very simple direct equity portfolio is very easy to build. Of course, it requires a lot of management. It requires, you need to worry about the dividends, how it comes in and so on. It's not insurmountable as a choice. That's all I'm trying to say. Of course, equity mutual funds have got benefits in certain things because you don't need to pay tax on the churn. But if somebody says, I don't want them, then there are choices available. That's my point. Don't misread what I'm trying to say here and claim I'm doing something silly. All right. So that's that. Now, the point is, if you go to the debt space, see, just imagine if somebody says no equity mutual funds, then immediately direct equity, buying stocks is the ready-made option, which is everybody can understand it, they will buy. But if somebody says no debt mutual funds, just imagine your retail investor will never buy the kind of companies that a debt mutual fund buys. So we have exposure to very exposure to certain areas of the bond segment which we will never buy as a retail investor. So if you actually think about it, a debt mutual fund is actually more valuable than an equity mutual fund. Of course, the debt mutual fund has got their own problems. We have learned in terms of credit defaults. We are learning things in terms of the Franklin issue. So you can't just choose debt mutual funds based on past performance like equity mutual funds. But if you are careful and if you know how to handle them, you can handle them. But if a person says no debt mutual funds also, then you have to stick to safer things like small savings instruments, recurring deposit, fixed deposits, PPF, EPF, whatever, and all those standard things. That's nothing new. Most Indians are anyway doing that. So it's not a big deal. So there are choices available, reasonable, good choices, good alternatives available to a mutual fund. And it is incorrect to say if you are not investing in a mutual fund, you are missing out on anything. You are not missing out on anything. You just need to be aware of what you are doing, aware of the pros and cons of your investment. Get your financial literacy, those 3 ticks right, and where you invest is up to you. Everything has got pros and cons. You just decide to embrace them. Yeah, incidentally, if you think, one last point, if you say that direct stock portfolio has got concentration risk, just imagine an index investor has got probably more concentration risk than a direct stock portfolio, because just 5-6 stocks in their index fund will have most of the weight in the portfolio. So it's not as if there's a best option. Just the problem is we are always worried about searching for that best thing. There is no such thing. We have to appreciate pros and cons and accept the cons. Any con that is acceptable is okay. Accept. That's it.